Hello, everyone, and welcome to the iSectors Market Review for the first quarter of 2024. I am your host, John Koch, the Senior Investment Analyst at iSectors, and I am joined, as always, by the CEO and CIO of iSectors, Vern Sumnicht. In this short video, we'll walk through a brief outlook on our current views of the economy and what our research is telling us about the market with regards to interest rates, the Fed, inflation, and money supply, among other things. We will also briefly highlight first quarter performance of the iSectors models and how these models can be utilized in various economic environments. As a reminder, if there's anything we don't touch on today, you can always view full performance data and written commentary on our website or reach out to us directly to schedule a one-on-one meeting. Without further ado, let's get to it. I'll hand it over to Vern to start with a discussion about interest rates and the Federal Reserve.
Thanks, John. I think that some of the research that we've been doing and looking at regarding the macroeconomic factors, and especially this inflation and interest rate situation that's been in the news. I think there's been a lot of talk in the news about the Federal Reserve cutting interest rates. And our look at that, as we look at it a little more closely, we think that the Federal Reserve is going to really have a difficult time. They're seriously between a rock and a hard place. If they cut rates, there's an inflation risk. If they raise rates, there's a recession risk. We're in a presidential cycle. It really looks to us like it's going to be a pretty steady interest rate environment, which means it's going to be a pretty steady stagflationary period that we've been in and we think will more or less continue in for the time being. If you look at that, though, in the graph below, we've highlighted the 5% interest rate over time. You can see that a 5% interest rate does not mean death to the economy, right? It is fighting inflation, and it isn't causing a recession right now. So we're kind of flat, but it's not terrible, and the economy can prevail with a 5% interest rate. It has in the past. It has with much higher rates. The Federal Reserve knows this, and when you take all of these things into consideration, it just seems to us the Federal Reserve is going to have a very difficult time lowering interest rates in this environment. And so the hold steady, even if they lower them a little bit, is a more likely scenario. John, you want to go to the next slide? Another, I think, interesting point in regards to this is the money supply. Obviously, this is increasing money supply is inflationary. We've been hearing a lot in the news media about lower interest rates, and we're hearing lower and decreasing money supply. We don't see that either. So M2 has been going down. And for a period there in 2023, M3 was also going down, but substantially less than M2 is being reported. M3 includes repurchase agreements, and that's a large part of the money supply. We don't think it should be ignored. And M3 has always been very important in our research. We know that in our research and our algorithms, M3 is much more of a tell than M2. And if you look at this recently, despite the news that money supply continues to be decreasing, money supply in a broader sense is still increasing and has turned back up actually since November 2023. So we think this is very important as well. It's another thing that tells us inflation is a problem and will continue to be a problem. You want to go to the next slide, John? This may be helpful. It's from Apollo's economists, and maybe it's a good way to look at it. They've kind of got a spread here, or a 2% on the low side and maybe 5% on the high side. We would be inclined to be up on that high side. That 4 to 5 going forward seems more logical to us. than the Fed's target of 2%. We don't think that's realistic that they will hit that, but maybe that's another way to look at it. And John can give you a little bit of a analysis of how we think this is important when it comes to allocating client portfolios. You want to go ahead, John?
Yes, gladly, Vern. Thank you. Before I go to the next slide, I just want to point out the blue line on this chart heading towards about 3%. That 3% number will be important as we look into these next charts and slides here. So based on the money supply discussion from Vern and that previous chart from Apollo, as Vern said, we think inflation is going to remain high. At the very least, it's going to remain at the same level, 3% or higher. In a higher, stickier inflation environment, we think that gold can act as a very important hedge in a portfolio with the potential to truly diversify a full investment portfolio. Oftentimes bonds are thought of as that diversifier of portfolios, but we'll see here that that may not be the case in certain environments. We've done some in-depth research on the diversification benefits of both gold and bonds in inflationary environments, high inflationary environments, and lower inflationary environments, with that 3% year-over-year CPI change being the critical line of demarcation, so to speak. So when year-over-year CPI is less than 3%, which was most of the last 20 years prior to 2022 and 2021, stocks and bonds have a very low correlation to each other, nearly zero, slightly negative. That's what you often think of when you think of a 60-40 diversified stock bond portfolio. However, over the last 30 years, when that year-over-year CPI change is greater than 3%, the correlation of stocks and bonds increases to positive 0.42. This isn't necessarily very high, but it is much higher than when inflation is low, going from basically a zero correlation to a modestly positive correlation between stocks and bonds over the last 30 years. Looking at gold and the correlation between stocks and gold, in both of these environments, it is almost the same. It actually gets a little lower when inflation increases, which is what you think of gold as an inflation hedge, becoming less correlated to traditional equity markets in those environments. And so this isn't the case either only over the long term. On the next chart, in more recent periods here, over the last 3 years, the same relationship holds true, even to a higher degree for stocks and bonds. Here I have it represented with ETFs, SPY for the S&P 500 for stocks, BND for the total bond market for bonds, and SGOL to represent the price change of gold. Last 3 years, the correlation between stocks and bonds, SPY and BND, is 0.71 positive, which that's an inflation environment even higher than 3% year-over-year CPI. We were seeing 4, 5, 6, 7, 8% changes in CPI year-over-year, which then that led to, in 2022, stocks and bonds both dropping together in tandem, leading to one of the worst years in over 100 years for a 60-40 stock bond portfolio. Bonds not really giving you the type of diversification you would expect in a fully diversified portfolio.
And John, wasn't that the only period that we had 3 down bond years in a row? Like historically,
right?
We've never seen bonds go down 3 years in a row. So it's truly bonds were not a good diversification, and you can see from the returns.
Right. Yep.
John has indicated here.
Yes, absolutely. And 2022 was a big part of those negative returns for bonds. They were not able to bounce back. Stocks bounced back in 2023 and so far this year. But bonds were not able to do so with this high interest rate environment that we've been in. And so,
oddly enough, if you would have had the gold over this period, you'd have been positive, right?
Yeah.
The stock bond portfolios were terrible. Simply adding gold would have given your portfolio at least kept you positive, kept you from losing money as market returns went down and bonds really went down.
It's interesting you say that, Vern. That actually leads perfectly into our next point here. Our post-MPE models have sort of picked up on that trend where they prefer gold as a diversifier right now to bonds. There have been times in the past where these models, specifically like in 2020 during COVID, they would look to long-term treasury bonds as their diversifier. They'd be 40, 50% invested at times into long-term treasury bonds. But if you look now at the current allocations of both the post-MPT growth and post-MPT moderate allocations over the last 7 months or so, they've had a near maximum weighting in gold bullion. Almost 30% is the max for both models, and they've both been right up next to that maximum for most of the last 7 months, and really most of the last year. They've had this high of an allocation to gold. Recently, growth and moderate, they've differed a little bit in their bond exposure, but gold bullion near max and technology near max has been a common theme between both of them. Sort of technology acting as sort of a proxy for the broader markets, and then gold bullion being that hedging exposure. I mentioned earlier, I showed the correlation statistics in this high inflation environment. Gold acting as a true hedge, a true diversifier, not only because of inflation, but gold can act as a diversifier and as a hedge with everything else going on in the world too. The uncertainty surrounding all these geopolitical tensions in the Middle East, Taiwan and China, Russia, Ukraine. So gold really, we focus a lot on inflation, but it really can hedge multiple risks at the same time.
At least investors have always flocked to gold in these geopolitical uncertainties as well as inflationary environments. Going forward, for my clients, I feel comfortable with that gold allocation in there. It definitely hedges a portfolio. Go ahead, John.
Yeah,
sorry.
Absolutely. Yeah, no problem. Not a problem at all. So coming to the rest of our models now, I have here highlighted, the arrows represent the different models I have pointed out here for different scenarios, economic scenarios. If you would ask me, what if inflation doesn't remain high? What if the Fed does cut rates in 2024? Inflation continues to go down, it drops down below that 3% threshold that I pointed out earlier. The good news is that iSectors has a model for basically any economic scenario that can be thought of. High inflation concerns, like I mentioned previously, not only are our post-MPT models allocating towards gold, but we also have a dedicated inflation protection allocation and a dedicated, even more narrowly focused precious metals allocation. Both of these models performed very well in the first quarter, outpacing their CPI benchmarks, which you would expect in situations like this. We also have models if the Fed keeps interest rates higher for longer, which is another thing that we sort of expect. But if that happens, our fixed income models I have pointed out here, the iSectors capital preservation allocation, which is the short-term bond portfolio, and the less of a dedicated short-term bond portfolio, iSectors domestic fixed income. It currently has a shorter duration, but that's not necessarily true at all times. But right now it is. They both beat their benchmarks in the first quarter. Capital preservation beating a dedicated short-term benchmark, and the domestic fixed income allocation beating the Bloomberg aggregate bond index.
We would encourage advisors, depending on their clients' objectives, to allocate, among our models, right? We would not expect you to take a full-on position saying, gold is great. Let's put all my clients' money in precious metals. That wouldn't be prudent. We wouldn't encourage that, but we would certainly, the models that John, for example, has highlighted would be very good models to allocate among, depending on your client objectives. Domestic fixed, domestic equity, some post-MPT growth, precious metals or inflation protection, and even if you can, and if your clients' risk objectives are consistent, even a couple of percent in the crypto block model would be a prudent thing to do in this current environment.
Yeah, agreed. Blending these models together works very well, and that's sort of why we offer so many different models. And we'd be happy to help any advisors who have questions about how exactly that would work. But so then rounding out the different environments, if the high interest rates I mentioned stay high and that leads to an economic slowdown of any kind, we also have the dynamic iSectors post-MPT allocations, which I touched on more specifically earlier, or the value tilted iSectors domestic equity allocation. All three of these models beat their benchmarks in the month of March. Post-MPT moderate specifically beat its 60/40 stock bond benchmark in the first quarter by nearly 140 basis points. So those models have been performing well, along with the first few models I mentioned. Vern mentioned the crypto block allocation. So that's one of our models that it could continue to have high powered performance if these sort of soft market conditions persist, these favorable market conditions persist. In the first quarter, the crypto block model had nearly 39% return net of iSectors management fees. Most of this return was powered by Bitcoin, with the enthusiasm for the launch of spot Bitcoin ETFs reaching a fever pitch during the first quarter. It pushed the price of Bitcoin to all-time highs, over 70,000 at one point in Q1. When those spot ETFs first launched in January, we weren't there day one. We didn't buy them day one, but we did end up implementing them in the model in late February, once we sort of became comfortable with the liquidity and trading dynamics of some of the larger players in the space. So that left the model to be about 60% invested in a couple different spot Bitcoin ETFs to sort of diversify the Bitcoin custodian exposure a little bit amongst 3 different ETFs. So 60% spot Bitcoin ETFs and 40% allocated to blockchain equity, crypto equity type of ETFs, Bitcoin miners, fintech companies, things like that, companies utilizing the blockchain as the use has sort of evolved and increased over the last few years here.
John, some of our thoughts on that too are that although we believe in Bitcoin and we think it's a great asset class and one we're confident in going forward, there's a big space out there in the area of crypto. So we want a more broad exposure to that. We don't know exactly, if Solana or Cardano or some of the other ETFs cryptos might do well or not. It's a big space, but the larger companies that have portions of their business allocated to cryptocurrencies, like John said, miners or exchanges, the picks and shovels, as they say, of the gold industry. We want exposure there, but we also want a good exposure to Bitcoin because we have a strong belief that is a powerful allocation for clients going forward. Not that we're going all in, but certainly you should consider a few percentage of your client's portfolio deserve an allocation going forward to that asset class.
Yeah, and the crypto block model is one of the very few. It's hard to find any others actually. 100% fully ETF crypto focused model portfolios available. So any interest in that, please reach out to us. We'd be happy to discuss.
And we understand that some of the platforms aren't allowing Bitcoin yet. They're not allowing some of the ETFs, but we believe they will continue. They've increased over the years, increased dramatically. And we think that will continue to open up. But if you have trouble and you need a platform that does allow allocations to cryptocurrencies like Bitcoin or the Bitcoin ETF, give us a call. We've got quite a few platforms that you can find crypto block on, even though there are some that are not yet. But we'd be willing to help you get it done. So we appreciate your interest.
Yes, definitely. Yeah. So any of the other models I didn't mention, some of the other ones had pretty good performance as well during the first quarter. You can find more detailed, specific performance attribution in the written commentary on our website if you'd like to dig in further. So that's all we have today. As you carefully look over the disclosure page, I want to thank Vern for his time this afternoon. I don't think we missed anything, right, Vern? I think we hit everything we wanted to, right?
Yeah. You did a great job, John.
Yeah.
Thank you.
You too. Again, so I want to thank everyone for watching. Here's the contact information for myself and our Director of Business Development, Scott Jones. Please reach out if you'd like to schedule a meeting or ask any questions pertaining to the materials we presented here today. That's all we have. Have a great afternoon.